I was always willing to look at the company fundamentals and not try to guess the stock market and focus on macro or trading. Yeah.
Okay, it's very simple. 2 columns. Do, fundamentals. Don't, macro, trading.
Most investors are not fundamental. They trade actively. They look at data points. They say, what's the catalyst? They don't really know what the company does.
What's the catalyst? The mark of a noob investor. When I hear that, that person's done in my head. It's done. It's over. What's the catalyst?
The fundamental approach has been key. Long-termism is key.
Okay, is Joel Greenblatt as successful as Warren Buffett? Is Joel Greenblatt as successful as Chris?
I saw Jason Calacanis do this the other day, and I wanted to correct him, but then I'd be teaching him something, which I'd prefer not. But he wanted the list of stocks by lowest PE. And you should never do this yourself, because what happens if you look at low PE stocks? Well, usually they're the companies that have high enterprise value. So like imagine Wendy's has 500 million cash flow. Well, the PE would be 5 times earnings. But that's useless because look at the enterprise value. You have to look at the enterprise value over earnings, which would be a more normal number, like 9 times. So you're just going to basically get a list of levered companies, right? So enterprise value to free cash flow or enterprise value to earnings, a lot better. You still have to pay the debt back. So cash flow goes to the debt, not to the stockholder, right? All right, revenue is dropping over at good old Wendy's, which is not a good sign. I haven't eaten there forever. Not that that makes a difference. I think you really should not listen to Peter Lynch. I don't think you should sit there and think, oh, because I like the product, I like the stock, and like people believed it. Maybe that might have worked 30 years ago, but that does not work today. Do not worry at all about what you think about the company and its product. It is absolutely not going to help you. It's totally useless. It doesn't matter if you like Wendy's or hate Wendy's. It's not going to help you look at the stock. It's going to really cloud your judgment. So I'm absolutely not thinking about the taste of a Wendy's burger right now. It doesn't make a difference. Generally are just going to confuse. Yeah, no, there are other parts of Lynch that were really helpful, but I don't think his whole go to the mall, see what you like. Like, I think he was just trying to be likable or something. But so Wendy's is levered up. Let's look at HMS, which is historical multiple stocks. So Wendy's is down 30% from December, roughly a year ago. Let's look at McDonald's as comparison. McDonald's is doing quite a bit better. Starbucks, basically anything's outperformed. Wendy's, only probably Sarepta's underperformed it. Sarepta. So do you want to buy the worst restaurant stock? Wow, Cheesecake's done really well. Chipotle's been almost as bad as Wendy's. There you have it.
And I don't think Buffett is right about short selling, other than that it's generally small time business. You can make billions short selling, but I don't think you can make tens of billions or hundreds of billions, because it's selling shares of a stock that's worthless, like D-Wave or IonQ or whatever. You sell those shares and eventually they're worth $1, book value, 10 cents, 50 cents, etc. Most of the stocks I've shorted over the years, they're not even listed anymore. They did reverse mergers or went bankrupt or whatever. If you look at my old stock picks, like almost all of them, the short sales they're not even in existence anymore. And of course, I've got a few wrong. Yeah, you can make hundreds of billions or even in trillions going long. Going short is it definitely has some more limits to it, because really worthless companies never really get to huge prices, right? The quantum guys, they're all trading below, sort of 5 billion or below, because the market there's almost like a physical reality of the market where it won't let it go up a lot more. And even if it goes up, sometimes there's a $10 billion company that's worthless, or 15. Even at that point, you still are in a place where, what are you going to do? Short the whole company? 10%, 20%? You can't really short more than, 20% of a whole company. But yeah, Tesla is a good example where you could probably short $100 billion of Tesla. if you're really convinced that, you know, in the long run, it's not going to work out. Now, in the long run, we're all dead, as many have said. Yeah, if you're wrong on a short, you can lose a lot. And that people learned that from Tesla. Trying to find this for ASW, but ASW, the problem with technical analysis is that people think there's no a priori reason to believe that it has any movement in markets. So I'll give you an example. I'm going to list 10 or 20 stocks here. Okay. I can actually pick, here's 10 random numbers. And I can basically say, well, Amazon is my long because, you know, this told me that Amazon's my long. And the problem is that, well, no, I don't think it's disrespectful. It's a common misconception. Part of this channel is to help people avoid pitfalls. Amazon is my number one stock because of my algorithm, let's say. Well, the problem is if you put this algorithm, which is just a random number algorithm, which TA is basically as well. Well, there's 10 stocks here. And 10 people employing this algorithm, someone's going to be right. And someone's going to say, well, my algorithm's working. Yours isn't. You're losing money. But of course, nobody has a perfect algorithm or heuristics or anything. So if you say, well, I'm up, you know, et cetera. Well, there's monkey throwing darts, astrology, rolling dice. I mean, you could use the name of the company as a seed to try to divine the future. People have tried everything, but you have to do p-value, statistics, etc., before you can determine whether or not, you know, there is a causality and repeatability. So think what the quants do is very different. So quants are not using technical analysis. I'll give you a few examples. So one of the major quant strategies, and again, statistical significance is really important. You know, here's a quant strategy, market making. So market making is a mean reversion strategy. It's a short-term strategy. It doesn't really work with technicals. It's an idea of the trade-off of liquidity versus price. The person pressing the market is trading off liquidity for price. You're trading off your liquidity for a better price. And that's why there's a systematic return to market making. Banks do market making with their so-called natural flow. So natural flow is customers. What's evolved in market making and why the quantitative market makers have taken a lot of market share, not all of it, but quite a lot of it, is such that they are doing market making without any natural. So when Point72 goes to Morgan Stanley and says, I want to buy 1 million shares of the stock, yes, Morgan Stanley is going to price them on market. But Jane Street's not doing any of that. They don't have any natural flow. They're just trading. So this is a strategy that's not really technically based. It's kind of more arbitrary. You know, any strategy that can show a p-value. So basically the point of any systematic strategy is a really simple point, which is prove it. Right? You know, codify it and prove it, which is what quants do all day, right? That is a basic 101. So if you can't prove it, whether it's back testing or forward testing, then it's not worth anything. So when quants try to find a strategy, generally they're trying to see, number one, they're trying to find logical reason why the algo should, and this is an important idea because algorithms shouldn't work for no reason. If you just find an algorithm in the sea of data that works, it's probably something called a spurious correlation or a back fit or a curve fit or something that's just not going to repeat itself. So there's a lot of, you could set any machine to do this and it's not going to repeat itself. This is a very classic problem in backtesting. And there's a lot of reasons as to why, but they're basic reasons. So the logical reason, no, 400 samples over 3 years does not count. I would never use that one because you're talking, you know, depending on your holding rate and stuff like that, you're talking about 400 samples chosen out of 100 million events. So that's just cherry picking.
Anybody can find a signal like that. And if it's only for one specific stock, that doesn't make any sense either. Whatever would work for one stock should work for every other stock. So that's an example of kind of like a bad algorithm. If you have a system, it's not hard to reduce it to, yeah, that's just not enough sample. If you have a system, it's not hard to reduce it to words, right? Like you should be able to take your system and write down, what is it that I do? When I see this, I do that. When I do this, I do that. And you just write it down and turn it into code. If you've been successful so far, you can afford to do this, right? It's not hard to do. And then go see if your system actually would make money if you employed it across the whole stock market all the time. And you'll probably find out that it doesn't, and that it's something else that's making you money. It's maybe your judgment, could be something that you can't put a finger on. It's a talent, many times it's a talent, but it's likely not to be, this system you have. What you read is not it's not a wasted education at all. It's just a book. Didn't take you a lifetime, right? I would read the academic journals. If you want to start, you really want to be a pro at this kind of stuff, there's both AQR and D. Shaw have printed white papers, which are not the same thing, obviously, as published papers. Let's see here, research. Some of these, again, are more white papers than research, but let's see. I like this. I don't know if they still, I'm sure they still publish. But yeah, I think some academic literature will get you further in understanding markets. I think that a lot of traders who are really good at trading, there's not actually a methodology that they have. A lot of it's pretty all over the place. Is alpha just beta waiting to be discovered? I'm thinking of some of the papers they wrote really long time ago. Non-cap weighted indices, market neutral investing, 1998 paper. These aren't necessarily in order either. Yeah, I did, Michael. I agree with it. There are some services like that, but generally, like the academic world, you're right, is a little bit of a different. Okay, so D. Shaw research is different from D. Shaw's published research. They have like a drug company. These guys used to do some interesting publishing too. A lot of guys have scrubbed their stuff.
Tiger was this big hedge fund that was sort of known for its bold, intrepid moves where it would short a stock if it believed in the short and just never cover. And so the Bank of Sumitomo had a rogue trader. You guys know what a rogue trader is. A rogue trader is a guy that works at the bank or a brokerage or a fund or whatever, and he's secretly putting in orders that he's not allowed or authorized to make. So this guy, Bank of Sumitomo, he's in Japan, he's buying the world's copper supply. Nobody knows, only him. These big banks are so disorganized that you could actually do that. There's a guy that did this at SocGen, Société Générale, the French bank, named 𝗏𝗏𝗀𝗏. There's a very famous trade. He put $6 billion position on without telling anybody. He just found a way to do it. He just picked up the phone and said, this is Jerome from SocGen. I need you to buy $100 million of spiders. And the other guy was like, okay, here you go. And so he kept doing that and it worked. And, nobody caught up to it until they did an audit. Well, this was what happened in the 80s with copper. Bank of Sumitomo kept buying copper and Tiger kept shorting it. And they said, I don't know, why is it going up? It doesn't make any sense. Copper is not worth this much. And they kept shorting it. And it wasn't a commodities rally like the other commodities weren't doing great. So it was so aberrant and bizarre. And they kept shorting. And eventually they arrested. Tiger didn't have any idea what was happening in Sumitomo, but they eventually arrested the guy at Sumitomo. The Bank of Sumitomo sold all their copper. They said, we are not supposed to own half of the world's copper. And they dumped it all. And Tiger finally either broke even or made some money. But again, the other positions, made Tiger a really successful hedge fund. They had cassava-like shorts and also great longs too. And you could take the pain on one stock if you're making money on the other ones. And I think that's something that's really important, is that you don't overextend yourself if you haven't built up this nice profit cushion. I built up a nice profit cushion. I can take some pain on D-Wave because I know it's going to end up like cassava. Now, I could be wrong, and I'm not going to have to lick my wounds and, retreat into my, convalescence for a while. But the reality is I think I'm going to be right, and we'll sort of see how it plays out. But I fully agree with you and understand, this is the paradox of the market. Irrationality gives us our profits, but it also gives us the pain of waiting for them to become profits.
I think the simplest answer why there's no concrete theory of near-term investing or trading is that if there were, it could be very easily systematically kind of created. I think the reason I believe in market making is, you're providing a trade-off, and the trade-off makes sense. So, for something to be exploitable, there has to be a pro to it and a con to it. Because if it's only exploitable, then it shouldn't make sense. It shouldn't exist. Academics want to get noticed. There's a really good software called, what is it called? It starts with a Z. It's a plugin, 𝗤𝗏. But none of those are going to be the high touch service that I think quants want or some other hedge funds want. Yeah, I'm not spending too much time reading papers these days, but I think 𝗤𝗏 is a great way to organize your academic research if you have it. What's better about IB? What is investment banking? Their secret is public-ish, and their returns have dropped a little bit. I'd say we're halfway there already, Joseph. It's not the secret got leaked. It's that many people are doing it, I think. There's only so many quant strategies, too. I think their secret is leverage, to be honest. Yeah, banks do it, too. Look up most of the banks' income statements. Goldman and all these guys, and you see how much money they make market making. Trust me, when these guys started their firms, they didn't have the 500 PhDs. Those guys have not, the 500 PhDs don't actually add much value to the firm. They look good. The same core structures is still there. Not a whole lot changes. Every firm's a little bit different, but most of the firms are a mix of market makers, trend followers, factor investors, kind of linear combination investors. And then more hard arbitrage like index arb and so forth, ETF arb. I guess if I told you you can make 5% a month, that's the mean. But the sigma is not a great representation of risk. So let's say the variability is say 2%. We say I'll take this, or let's think about it as choice A. Let me give you choice B is maybe more important. It's a 1% monthly return, but the commensurate ratio. So it's at 0.4% variability. This is not that outstanding. So let's say you levered this to that, or even levered this even further. The sigma is not, even that important of a metric. I can even lower this to like 0.1%. The problem isn't the standard deviation. The problem is that you have to sort of balance it over a distribution of returns. And the distribution has a lot of properties. It's not just sigma. It's also, so let's say these are readings. What are we saying? Most of these readings cluster around one, right? One sigma. So let's argue this is kind of what we see. They even shouldn't be on XY axes, but let's say this is what you see. And then you have one big fat, guy here that you haven't seen yet, but he's lurking. This is kind of the problem with this model. You're just going to think this is like reasonably well behaved kind of, but you just don't have enough observations. And even if you do, the actual governing dynamic or first principle of the market could still be something that evolves. For example, the amount of quantitative market participants has grown dramatically. The amount of people in the same trades has grown dramatically. So what a lot of these funds don't want to do is lever this up to this or higher. I think there are some firms willing to do that, because a 20% drawdown or something like that, even a 30% drawdown, is tolerable because let's say you don't have outside capital. Let's say you're a true market maker or proprietary market maker, kind of no hedge fund, no limited partners, just you and your boys, which was the way Susquehanna worked and the way Jane Street worked and all this stuff. Then you might say, well, we can survive 30%. In the hedge fund world, you'd say, I can't survive 30%, although some people certainly try. The limited partners will want their money back because I've advertised that I'm a systematic investor that will never go wrong. So you might say, I'll take this and maybe, 2x lever it or something like that. So anyway, it's and you might want, different strategies that sort of take this and do different things with it, or, you have strategies that will actually perform differently when this strategy is doing well. Maybe there's a strategy that is really not correlated that you can also apply. So most of these models are mean reverting models. Market makers, by definition, mean reverter. So spreads will blow out and statistical observations will seem rare, and you bet on the spread closing and the spread gets wider and wider. And the nice thing about not having as much leverage is you can ride it out. But if you have a lot of leverage, you could be down 20 or 30%
pretty fast, because some of those returns are actually, those are all levered already, right? The market maker algo that I run sometimes is like 3-to-1 levered already. So leveraging that more to get your target return. Let's say you say, I want to be like Medallion, I want an 80% return. Cool, you can do that with anything. You could take your biotech book that you think is going to make 20% this year, 4x lever it. The problem is that you're not as consistent as Medallion, right? A bad month for them is like flat to down small. Bad month for you or me, if you lever that 4x, you'd be out of business. So, or close to it. So you got to find something that's so consistent. And if it's so consistent, it's probably not a big effect, right? It's like just like medicine. You know, you might be getting, like I said, 50 basis points, 1%, but it's consistent. And that you take up and lever up. And yeah, it's a more risk averse because of the 3,000 or so positions you have, which provide a bit of a buffer. But the problem is that buffer can be illusory when everyone has the same 3,000 positions on, because everyone has the same trade on. It's not a great, you know, the different carry trades and their different configurations tend to blow people up. You know, 𝗥𝗡𝗏 blew up on the Swiss franc because the Swiss franc never had a 10% move in a day ever, I think. It had a 10% move. The Swiss bank said that they wouldn't peg it or something like that. And then somebody blew up, I think 𝗥𝗏, some other firms, and it retraced immediately. So, you know, no matter how comfortable you feel that your mean reversion will work, it might not. When 𝗏𝗏 happened, you know, and 𝗙𝗀𝗀𝗍𝗍 Capital blew up and almost took Renaissance down with it and other firms, Merck and Pfizer and J&J, like drug stocks I was looking at, were up or down 10 or 20% for no reason other than 𝗙𝗀𝗀 had to sell them, which made Citadel have to sell them, which made Millennium have to sell them, which made Renaissance have to sell, you know, and Renaissance did something that was very rare. In the past, when they were at the brink, they didn't override the model. This time they overrode the model. Simon said, cut the positions. And the traders really, the people at the firm, the partners, the traders, everybody, they really didn't want to do it because they knew that if we're cutting the positions, we'd make the spreads blow out further.